This is TreppWire Week in Review for the week ending April 5th, 2024. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. Markets have been on a slide to start the second quarter, and Treasury yields have marched higher. Thursday's trading session was particularly interesting as stocks were in positive territory for the first half of the day before indices sold off more than 1% over the last 3 trading hours. In your opinion, Stephen, is the sell-off we've seen to start the quarter just a natural correction after a strong end to the first quarter, or is there something more concerning going on behind these numbers?
For right now, I'm going to play the optimist card and say right now this feels like the momentum trade that was carrying us into a strong end to Q1 has just been cooling off. Now, there are some things around the fray that do have me wondering, how much of that will hold true or prove correct in the long run. I shouldn't say long run even. We're going week to week, right? So let's unpack some of the data trends. We've had the largest 4-day drawdown on the S&P since October. Gold's been rallying. VIX was up 15% on Thursday, and commodities, and in particular, oil has been marching higher, partially driven by Middle Eastern tensions. So all of that going on tells me, okay, there's a little bit of this is macro risks globally in the background. It's some of the momentum trade. And on the macro data front, what's been interesting this week is we've had some mixed economic data. So we've had a particularly strong ISM manufacturing report that came out. The ISM services data has been cooler, at least compared to the last few months of data. And the jobs numbers that we've gotten so far, granted, this is not the heavily watched Friday jobs numbers that will be released on Friday. So right now we're recording on Thursday, so we don't know tomorrow's report yet. But between ADP and the unemployment numbers that we've gotten so far, it's been kind of a mixed bag. So ADP came in stronger than expected, and initial jobless claims came in a little bit higher than expected. However, continuing claims pulled back a little bit, indicating that there's still strength in the labor market. So collectively, again, the data points to a generally strong macro backdrop. And with the manufacturing and the services data in particular, that's going to be the interesting thing to watch. So manufacturing has been getting creamed, or was kind of like the laggard the last few months. And so to see that kind of treading steadily back into positive territory, and now with services cooling off, it'll be very interesting to watch what happens with the inflation data. Will we start seeing some cooling in the services inflation, in particular, housing? Obviously is one thing that we're watching, and the wage numbers as well. So there's just a lot of conflicting data right now that we just have to take in stride and recognize that while this week feels negative at face value, we were coming off of a very strong end to the first quarter.
Yeah, I think that sums it up, Stephen, is we're in a week-to-week business on this podcast, and the markets seem to be in the day-to-day business. And to your point, we had, a pretty strong run up, and now maybe there's just a slight correction here. And there's no single data point that indicates why the markets are where they are today. I mean, the job stuff you highlighted, just to add some context, according to this is ADP private sector hiring, 184,000 new jobs in March, which is the biggest jump since July. And then the job gains were revised up to 155 in the prior month, which was about 15,000 higher than the previous estimate of 140,000. I did take away one other nugget from that commentary, was that ADP reported that wages for workers who stayed in their jobs increased 5.1% from a year ago. So I think that's a pretty good sign relative to what we're seeing with the inflation front and everything else. So it's an interesting dynamic. And so the strong, labor market continues to persist. We'll see if this is just a blip on the radar, and next week we're talking about, the market's going and ripping again. I mean, I wouldn't be surprised either way. And as we kind of know, we're in April now. We're getting closer and closer to the election part of this election year, right? And so I don't know if you guys have noticed the uptick in political ads on TV and other things, but I would expect the market over the next couple of months to really go a little bit haywire, just, where we're at in that part of the cycle. So, interesting week. I wouldn't read too much into it, but we do have some pretty good news on the CRE side that we're going to talk about today, in particular, the delinquency data.
So yeah, Lenny, the good news here is that the delinquency rate for CMBS did drop slightly in March. And in particular, this was helped by a strong improvement in the retail sector. So something I love to see. Now, there's a little bit to unpack here. So let's dig into the numbers. Overall, the delinquency rate declined 4 basis points in March to 4.67%. The decline was almost exclusively due to continued improvement in the retail sector as it notched its 4th consecutive monthly decline. The retail delinquency rates declined 47 basis points in March to 5.56%. And ironically, the office sector was one of the only 2 sectors that saw a decline. So retail and office were the only 2 that improved, which had been the ones that have been struggling the most. So again, a very positive trend. So the office delinquency rate declined 5 basis points to 6.58%. What's going to be interesting here is, I'm going to go ahead and pivot and transition straight into the CMBS loan loss report, which was the other major report that we released this week. So the volume of loan losses increased in March, and we had 496 million of loans that were liquidated at a loss across 13 loans. So this was 279.6 million in losses in total, carrying an average loss severity of 56.38% for the month. This was an increase in the loan loss volume from February, where losses totaled 92.5 million. Now, the 12-month average disposed loan balance moved to 274.3 million, up from the 239.9 million that was seen last month. So the 12-month moving average loss severity rate stood at about 58% in March, slightly up from the 57.97% in the month prior. Now, the reason why I say that the losses report, delinquency reports are important to take together is the reason for the large improvement in the retail delinquency rate was that we had a number of very large retail loans resolved this month. So these were some malls that got flushed through the system that ultimately took some long outstanding retail distress out of the numerator. Been waiting to see this happen. And so to me, this is a good sign to see some of these loans clear and that we're not bringing in more distress into the numerator and the delinquency rates, and taken alongside with the transaction volume pickup that we've continued to see. It's not that I want to say the momentum continues to increase, but at least it's sustained. For loans to be liquidated in this environment is a very, very good sign, because when prices are continuing to decline and we're not sure exactly if we're past the trough yet. I mean, that's the point when you typically see inaction. So when you start seeing liquidation volume pick up, that usually means that you're closer to that sweet spot of the cycle where we should start seeing some improving momentum here on the positive side.
Yeah, we've seen a lot of people on Twitter, and we've had conversations with folks that we're seeing a lot more action on NPLs and people willing to make deals. And to your point, Stephen, like that part of the transaction market had pretty much been frozen, and it's good to see. I mean, it's not great. Like, obviously you want properties to perform, you want properties to pay off, you don't want note holders to take a loss. But to your point, when you start seeing some of this transaction activity pick up, it does give you a sense of optimism that people are kind of feeling like we're at the bottom, and that usually means that the market stuff is going to pick up on the traditional side of the transaction docket. So I did want to add a little bit. I say this because it's ingrained in my brain, because we've talked about on so many presentations or whatever, that the all-time high for delinquency is 10.34% in July of 2012. The point I make when I say that in the presentations is just that, the GFC started in 2008. We didn't hit peak delinquency until July of 2012. Take that for what you will, but in my mind, it means that for this cycle, we're still very, very, very early in the distress part of the cycle. And so while we're seeing some transactions in some of these NPLs or whatever, those are the best of the worst. The reality is the worst of the worst is probably still lingering out there in terms of obsolescence and other challenging factors for these properties. So as an aside, 10.32% was the next high water mark, which was due to COVID, and that happened in June of 2020. But as we saw, a lot of that was just people preemptively not paying and then, leveraging that to get a little modification or whatever during that uncertainty. I did want to mention too, not to go back to the open, but I did see something on Bloomberg today that said this week is on pace to see a new record for the most large company bankruptcies since 2009. So just as an anecdote to kind of the maybe the market stalling a little bit this week, there were some pretty frothy headlines for large company bankruptcies this week, which may provide a little bit of a spook to the market.
Absolutely. I think we talked a little bit about the zombie rollout that had been mentioned last year. And, I think that's basically just been pushed over into this year. And so it's eventually, finally caught up to where we all thought, it would get. There's a lot of companies that have been unprofitable for 3 or more years. That's what we call a zombie company. And so you can survive in that sort of a situation when rates are extremely low, but when their cost of debt has, really ratcheted up very significantly, and they're starting to have to roll some of that debt, it's forcing some of these bankruptcy decisions. Because to your point, Lonnie, I've been reading through some of these bankruptcy headlines, and especially in the evening when I'm doing my leisure reading, because let's face it, bankruptcy reading is leisure for me. And so, it's been interesting to see the reasoning behind some of these, and if they're Chapter 7 versus Chapter 11, and what exactly was it due to? Was it just kind of unfortunate circumstances, a high debt load? Something else completely out of the blue, and the debt load keeps coming up, the leverage point. So, consistent with the zombie roll up type calibration.
Yeah, so we hope we only see this as a blip, and this isn't part of something broader. And I'm confident that that's probably what this is. You had a couple of companies, a handful of companies that were over leveraged. Cost of capital is extremely high for them now, and maybe sales performance and some of the other downward pressure on consumer spending is starting to get to them. But I just wanted to make sure that we did add some color there, that there were some other big stories that we didn't get into detail on, but that potentially could have impacted activity this week.
And let's jump right into our property type segment. We want to start this week off with multifamily. And first up, we saw a multifamily property in Chicago that actually served as collateral for a 2018 CMBS deal get put up for sale.
Yeah, so this is an interesting story because Chicago's gotten a bunch of negative headlines for office and retail, but it seems like some of their multifamily has been able to weather the storm. I don't think this is one of those cases, though. So we have the Vantage Oak Park Apartments, which is in Chicago's suburb of Oak Park, as Haley mentioned, is being offered for sale. This is coming to us from Crane's Chicago Business. This property has a $66.6 million loan, which is about 70% of a Freddie Mac deal from 2018. 270 unit property, fairly new construction, built in 2016. That securitization had an appraised value of just over $107 million. This loan was placed, though, on the master servicer's watch list last October. DSCR fell to 0.62x, and cash flow obviously didn't cover the debt service once it dropped below 1. And the fall in DSCR, Stephen, this is something we've talked about at length, was due to the rate cap cost. So this was a floating rate deal. That rate cap increase cost ate up all of the additional cash flow and actually put this below 1.0x. So if you look at first 9 months of 23, DSCR was 0.62, just a challenge for this particular property. But I also think a challenge more broadly. Now, this loan doesn't actually mature until February of 28, but as we mentioned, is being offered for sale. And so, is this something you think we'll see more of, or is this kind of a one-off based on your analysis of the data?
It's hard to say quite yet. Part of me thinks that we will see a little bit more of this, given what at least we've heard coming out of the construction sector, where you're having some newly constructed multifamily apartments sell, basically at break even, or in some cases a slight loss. Granted, that's the construction market, not stabilized, part of your core portfolio. But I do expect to see a few more of these. It's just hard to say, how much of a trend we'll get out of it. I will say there are positives and negatives to this story. Reading through the servicer commentary on this particular loan, there's some encouraging data points here. And that the asking rental rates decreased slightly in Q4 due to seasonality, but they remain strong compared to what they had budgeted. So they're achieving an average effective rent of $2,343 at this complex versus $2,295 that was budgeted. And so, to see the rents hanging in there in a market where we've had, to your point, Lonnie, some negative headlines come out, and see comments like that, that's a great thing. And like you said, the interest rate cap is still a big non-negligible factor for some of these loans, because it still is extremely costly to buy an in-the-money rate cap to get down to what the covenants require, whether it's break-even debt service coverage, a 115 or a 125. It's very case specific.
Yeah, I think we're at the part of the cycle, and I know it's a little bit different in New York, just because of the nature of the density and the style of apartments. But here in the suburban multifamily markets of Texas, we're back in the balloon and now leasing sign phase of the multifamily cycle. So like we were driving past a complex, there's 76 balloons that are getting blown up every morning and hanging with string. And then there's a big, huge sign with an arrow that says leasing office. We haven't seen that in probably 5 years. And that just means that while the data maybe doesn't show huge concessions at this point, they're coming. Like those balloons and all that work for the leasing consultants daily doesn't happen until they're struggling to get the occupancy where they want. So I think we'll see some more of this in some of these markets where the rental rate really, the pressure has put rental rates down, in addition to these other financing costs, the rate caps and other things that we discussed with this particular deal.
So is the data point we should be looking at balloon sales and rentals or purchases of the crazy waving arm guy?
It's just crazy. Like I won't say all. There's a lot of apartments that do that. I just don't think that actually positively impacts the financial positioning of the asset. I mean, like obviously I haven't lived in an apartment in a while, but I'm not inclined to like, oh, those are some really solid balloons. Like who did that balloon arch? I got to get in there and get me an apartment. Like it just doesn't seem to resonate, but it's kind of like what's been happening since 1986, and everyone just keeps doing it. So yeah, maybe we should start tracking helium and balloon sales in the suburban multifamily markets. So we do have one more Chicago multifamily story, Steven. So Crescent Heights paid $80 million, just over $404,000 per unit for a 198 unit property located at 850 North Lakeshore Drive in Chicago. This story comes to us from The Real Deal. The Crescent Heights, which is a Miami developer, purchased the property from JP Morgan Asset Management, which had previously acquired the property back in 2016 for $140 million. JP Morgan financed it with a $70 million loan from Nationwide Insurance. The latest acquisition was financed with $61 million loan provided by Centerbridge, Martello Advisors, and Massachusetts Mutual Life Insurance Company. Property is an older property built in 27, and units have up to 3 bedrooms with washer, dryer, stainless steel appliances. That's a tough one. 2016 transaction at 140 million, now trading at 80 million. 404,000 at face value sounds like a pretty strong sales number, but in comparison to what it previously traded at, and especially on Lakeshore Drive in Chicago, gives you a pretty good indication of where that market is. Now, there's some caveats. This is an older property. While it says it has some updating, not sure of the condition of this asset relative to the market. There's been a lot of newer construction, highly amenitized buildings in that submarket, but still pretty tough pill to swallow if you're JP Morgan Asset Management on this one. So one more multifamily story, Stephen, as we round this out. There's news that Berkadia provided $157 million Fannie Mae loan to facilitate the purchase of Mason at Van Dorn, which is a very large property, 1,180 unit complex in the Washington, D.C. suburb of Alexandria, Virginia. This property was built in 63 and 67, purchased by a venture Shoreham Capital and Bridge Investment Group from an affiliate of CIM Group. So CIM has been pretty active. We've talked about them on a couple of podcasts recently. Purchase price wasn't immediately known, but CIM had last transacted on this property in 2018 for about $228 million. If we look at the properties and give some detail here, the property, which was previously known as EOS 21, generated $11.32 million of NOI. That would compare, fairly favorably to the $11.31 million of NOI it generated in 2022, and was up significantly from the $9.76 million NOI it generated in 2021. This property had some debt against it. Again, we don't know the sales price on this one, but this property had a $60 million loan, part of a 2018 deal, another $60 million loan piece, part of a separate 2018 deal, and a $30 million loan, part of a third 2018 deal. So pretty interesting composition of loan structure on this particular asset. It had been current, so there was no distress on this deal in terms of non-payment, but it was added to the watch list in February of 24. Servicing commentary notes hazards at the property according to the most recent physical inspection. This loan was slated to mature in December of 24. And given the news, it may show up as defeased in our next month's remittance, given that the loan is only open for prepayment at par for the last 3 months before maturity. So we'll see how this one plays out, but it was of interest given its connectedness to the CMBS market, and the possibility for it being defeased outside of the open window.
And let's turn to the office segment. We saw a bunch of sales this week.
This first one we have has a fantastic price per square foot. So first up, we have an office in Miami's design district fetching a really strong price. Store Capital has paid $27.2 million, or approximately just under $1,400 per square foot for the roughly 20,000 square foot office at 3704 Northeast 2nd Avenue in Miami's design district. And this comes to us from the South Florida Business Journal. The Scottsdale, Arizona company purchased the property from Stockbridge Capital Group of San Francisco. The 7-story building opened in 2018 and is fully leased to the fashion school, and apologies if I get this pronunciation wrong, Istituto Marangioni. Yeah, I probably butchered that thing. Tried to do my best Italian, so sorry, folks. Istituto Marangioni. And this is under a 30-year deal. So any Italians out there, help me out. Cut me some slack. How do you pronounce this name?
A for effort. I'll give you A for effort.
Thank you. Next up, the Charlotte Business Journal reported that Vanguard Group paid $117 million or $167 a foot for the 700,000 square foot office campus that's currently under construction at 2405 Governor Hunt Road within the University Research Park area of Charlotte, North Carolina. The Malvern, Pennsylvania investment giant bought the property from Centene Corp., a St. Louis healthcare company that previously had planned to house its East Coast operations at the property. Centene abandoned those plans, but continues to own 50 acres of undeveloped land at the site. Vanguard will consolidate its Charlotte office operations, totaling some 2,400 employees, into the property, which is slated for completion sometime next year. The company has had offices in the region since 1997. JLL represented Vanguard in its purchase, while Cushman & Wakefield represented Centene.
Yeah, for a little more color on that one, Stephen, the previous CEO of Centene passed away, and I think it was his vision to get this project underway and to move the company there. And when the new CEO took over, they decided to keep the company in Missouri. So this is a net positive in the sense that Vanguard, gets to move into an upgraded, better building and consolidate their employee base. But I think there were some incentives and some other things to try to get this one off the ground. And I think, big picture takeaway here is like when municipalities and others start offering things to get developers to build new buildings, that's a pretty fickle business, unfortunately. Things change, and in this case, it seems like it worked out well. They were able to transact, and there's going to be somebody occupying the space. And they still have the 50 acres that you talked about of undeveloped land, so maybe at some point they decide to come and do something else there. But an interesting story how, a change of leadership could really impact, one community in a negative way and one in a positive, in the sense that they kept the business in Missouri. And we wanted to just give a shout out to Addison D for sending us some of the color on this particular story. Thank you for sending that information to us. And we love getting some feedback from listeners with some scoops on transactions in their backyard. So Addison, thanks for sending this over, and glad that we're able to talk about it on today's podcast.
Now, this next story up for the office sector is probably one of the best green shoots we've had from an office story in a couple weeks here. So New Jersey Transit recently signed a massive lease for 407,000, almost 408,000 square feet at the Gateway Center office complex atop the Newark Penn Station commuter hub in that city. The lease, said to be the largest ever in the state, called for the state agency to pay $39 per square foot for its space, subject to 2% annual increases within the 2 Gateway building. That would bring the lease's total value to roughly $450 million over its 25-year life. The deal doesn't take into account any concessions. The agency is getting some rent abatement and a hefty allowance for its build out of the space. It also doesn't take into account the fact that the agency can increase its footprint at the building. 2 Gateway is one of 4 buildings within the complex, which has a total of more than 2 million square feet. It also has access to 2 parking garages with just over 1,000 spaces, which was crucial in winning the lease with the agency. The building has 821,000 square feet, so the agency will be taking roughly half of that space. That will take the complex's occupancy to 87% from its current level of 63%. A venture of Garrison Real Estate Fund 4, Taconic Opportunity Fund, Axonic CRE Distressed Fund, and Onyx Equities owns the complex, having acquired loans against the properties at discounts from the CMBS trusts that held them. Since taking over the complex a few years ago, the venture has substantially upgraded the retail promenade that runs between the 4 individual buildings. They'll now pony up additional capital, said to be $75 million, to upgrade the 2 Gateway building. New Jersey Transit currently occupies the nearby Penn Plaza East complex, where it owns and occupies roughly 330,000 square feet. That space, the 2 buildings the agency occupies, were built during the early 1990s, and they would require an estimated $120 million to upgrade. The agency was represented in its space search by Savills. While the agency is moving from one location to another within the same city, its new headquarters could bring added life to the Penn Station and Gateway complex areas. The Newark office market has 49 buildings with a total of 15.5 million square feet, according to Colliers, and it had a 20.3% vacancy rate at the end of last year, and asking rents averaged $30.63 per square foot. The space that New Jersey Transit is taking effectively will be the newest and most highly amenitized in the market.
Not without a premium, though. If asking rents are $30 a square foot in that market, and they're now, getting $39 for that building, it's a pretty nice uptick. When you read the intro to this one, Stephen, the New Jersey Transit recently signed massive lease, I just figured the cost for using the transit is, the rail is going to be significantly increased as well. And this is a good story in the sense that large lease, large square footage, big agency should be good for that local municipality. The knock-on effects of having more people there, retail, other things potentially being bolstered. So hopefully this is, a sign of things to come for that location. And that submarket, as you read off those details, 20% vacancy rate, could use some good news.
And let's shift gears. We also saw some value reductions for offices across the country this week.
First up, the property backing the $21,042,001 Connecticut Avenue Northwest loan saw a drop in its appraised value. At securitization in March 2019, the property was valued at $32.4 million, but its value was cut to $12.9 million in an appraisal that was dated September of 2023, following its transfer to special servicing and entering cash management in June 2023 due to imminent monetary default. The loan has been delinquent since August 2023, and the receivers had control of the property since November 2023. The receiver is controlling the property, addressing deferred maintenance, and working with leasing prospects for the vacant space at the property. Prior to receivership, ownership had invested approximately $6.56 million of capital to upgrade the building since 2009. According to commentary, the loan is secured by a 6-story, just under 71,000 square foot Class B+ office building and a 104-space subterranean parking garage. This property was built in 1966 and renovated in 2009. The most recent debt service coverage ratio, based on a net cash flow basis, was 1.08 for the first 9 months of 2023, when occupancy was 82%. This was a further deterioration in performance from 2022, when the debt service coverage was 1.32 at the same occupancy, and 2019, when the debt service coverage was 1.76% and occupancy was 100.
I think something we could consider doing here for the podcast is reaching out to the leasing brokers that are trying to backfill some of these spaces, right? To see what is the strategy? Because in this case, the property has had deferred maintenance. They put a bunch of money into it to try to upgrade the building, but they've had significant turnover. Occupancy has obviously struggled. What is the go-to-market strategy for something like this to try to salvage the building? I mean, the appraisal value has been reduced. There's a lot of negative things, but that there's somebody with the sign up there trying to position this as, a viable asset in the marketplace. It'd be really good to get some color from people to say, how are you positioning some of these older buildings that are struggling to maintain their, relevancy in the marketplace. I think that might be something. So if you're an office leasing rep, working for the property owner side, and you want to share some inside baseball with us and maybe provide some details, shoot us an email at podcast@trepp.com, and we'll shout you out on an upcoming pod episode. I think it'd be interesting to see. Obviously, if you're a tenant rep right now, we see a lot more positive posts from the tenant rep community in the office sector across social channels. But it'd be really interesting to see how some of these landlord reps are trying to salvage some pretty tough situations.
Up next, we have in Kansas, the property backing the $17.2 million YRC headquarters loan saw a drop in its appraisal value to $9.7 million. At securitization in 2014, the property was valued at $45.3 million, but its value was cut almost 50% of the current loan balance in an appraisal dated January 2024, following its transfer to special servicing in July 2023 due to imminent monetary default. The property's single tenant, Yellow Roadway Corporation, is a subsidiary of Yellow Corp, which filed for bankruptcy in August 2023. According to previous watchlist commentary, the tenant vacated earlier, but rent roll still showed that its lease ran through March 2024, with the tenant continuing to pay rent. According to servicing commentary, the special servicing transfer was at the borrower's request due to this tenant event and the tenant's intent to vacate their space at expiration. The loan has now been delinquent for 4 months, and remittance files indicate that foreclosure is the current resolution strategy for the loan. The collateral is a 333,000 square foot office property built in 1972. It's located in Overland Park, Kansas, a suburb of Kansas City, Missouri. The loan matures in December 2024. The $17.2 million loan makes up roughly 2% of the collateral behind a 2014 deal that is part of CMBS 8. And finally, a story that we had previously covered, but now has some new developments. Last month, we wrote that the Manhattan office backing the $34.5 million 252 West 37th Street loan received a reduction in appraised value to $53.5 million from $75 million, which had been the appraised value since securitization in 2014. The loan was sent to special servicing on October due to imminent default, and a cash trap period was also triggered due to the debt service coverage ratio falling below 1.10. In 2021, the loan posted a debt service coverage ratio of 1.46 when occupancy was 66%. However, that debt service coverage ratio has fallen below 1 in 2022 and the first half of 2023 when occupancy was 60% for both periods. March 2024 servicing commentary indicates that the borrower had been unable to obtain take-up financing prior to the impending maturity in January 2024 and requested an extension. Servicing commentary noted that the lender had previously been dual tracking the foreclosure process while discussing workout alternatives with the borrower, as well as that local counsel had been retained to, quote, file for foreclosure and or receivership if necessary. The Real Deal reported on April 3rd that Wells Fargo is suing the borrower on behalf of CMBS bondholders seeking to foreclose. The collateral is a 161,000 square foot, 17-story office in Manhattan's Garment District. The property was built in 1928 and renovated in 2013. The loan has seen debt service coverage ratio and occupancy sag in recent years. The delinquency status in the loan has switched back to current this month. And this particular loan makes up 8% of the remaining collateral behind a 2014 deal. So this was an interesting one, seeing the lawsuit come out from Wells Fargo on behalf of the bondholders. So essentially signaling that, yes, the intent is to foreclose. But yeah, Lonnie, let me get your thoughts on this one.
Yeah, Stephen, so you did a really great job of covering that one. And this actually, kind of segues us to a topic of commonly referred to in the CMBS universe as potential bad boy carve-outs, right? So if a borrower doesn't uphold certain requirements per the loan docs, then, they do lose that shield of, non-recourse, right? Where they could be held liable for some of or all of the debt. So I know in some cases, if they don't pay insurance or they don't pay taxes or, something like that, they don't stay personally solvent, et cetera, it could potentially trigger some of this personal liability. We don't know at this point, obviously, if any or all of those things have occurred. But it is interesting to see that they're potentially trying to go after the borrower on this. So more to come on this one for sure. And we'll just kind of see where this plays out. I mean, I think it's interesting. I mean, this is the nasty side of the distressed market. Like we've covered a lot of deals where, we've seen an extension or modification, and those can get hairy. But in most cases, both parties at some level come to the table and they reach some form of a compromise. In this type of arrangement where they're dual tracking, foreclosure and potentially going after the borrower, much stickier situation, and unfortunately, usually doesn't end, with an amicable type of workout solution.
Yeah, it's something just really important to note here and stress again what Lonnie said is if you have a CMBS loan and it is non-recourse, just something to bear in mind if you're even thinking about handing over the keys is you really want to keep paying any of those things that could trigger a bad boy carve out. Because even when the special servicer might say, in writing or verbally, yes, we're fine with taking back deed to the property. If they go radio silent for a couple of months, there's no guarantee that, if you let one of those payments, your tax or insurance payments slip, that won't trigger that bad boy carve out and they'll come after you for personal liability.
And let's talk about industrial. We saw some movement for some properties there this week.
Yeah, so I'm going to jump in on this one, Steven, since this is in the old great state of Texas here. We had EQT Exeter purchase an industrial property for $60.9 million, $135 a square foot. This property is 450,000 square foot at 110 Southeast Interloop Road in Georgetown, Texas, not far from Austin. In fact, it's about 31 miles north of Austin Bergstrom Airport. EQT Exeter, a non-traded REIT, bought the property from its developer, Portman Holdings of Atlanta. This is the first acquisition for EQT, which was launched late last year. The property was completed last year, is fully leased on a long-term basis to GAF Energy. They make solar roofing. This is a very nice building, 36-foot clear heights, 106 loading doors, and parking for more than 500 cars and 123 trailers. And that submarket has been really strong. The surrounding suburbs outside of Austin have seen this significant growth in industrial appetite, and there's been a lot of new construction out there. And it makes sense. Very close proximity to I-35, easy access to the airport. And so this is a good solid deal. $135 a square foot in that market, while lower than what we've heard in some of these other markets at $300 a square foot, is a really, really strong sales price for that location. We had two other transactions here. Hialeah, Florida, where we had Woodhill Real Estate Partners purchased a portfolio of 6 warehouses totaling 158,000 square feet for $26 million or $165 a square foot. That sale comes to us from South Florida Business Journal. So Woodhill purchased these from Ronald Siegel, who's a Pembroke Pines, Florida attorney who sold the industrial properties. This is across multiple addresses, 215, 235, 315, 325 West 75th Place, as well as 7750 and 7620 West 2nd Court. These are in the Amelia District, which were built between 1964 and 1971. And Emeritus Life Insurance Company provided the buyer with a $15 million mortgage on this deal. So pretty low loan to value, pretty strong sales price for that market. And then last one here, Stephen, I'll get your thoughts on the 3 transactions. Clarion Partners has bought the TIA Logistics Center, 245,000 square foot warehouse in Tampa for $49 million, or about $200 a square foot. This sale comes to us from the Tampa Bay Business Journal. New York investment manager purchased the industrial property from Scannell Properties of Indianapolis and Legacy Development Partners of Tampa. The property itself is at Knox Street and Hoover Boulevard, is near the Tampa International Airport and the Tampa Airport Logistics Center. It's fully leased to Fanatics, which we've talked about on this podcast before, an online sports apparel company. So maybe a little bit of a premium there, just given the close proximity to the airport and the logistics center, and a nice solid sales price at $200 a square foot.
Yeah, I like this last one because we've had a few stories over the last few weeks where Clarion was the seller. So it's nice to see them coming up as the buyer on transaction, obviously rebalancing or rejiggering their portfolio a little bit here. And yeah, on that second to last story in Hialeah, yeah, that leverage point, like you said, Lonnie, is pretty conservative, roughly 57% LTV, I think. My math is correct. So interesting to see, a very conservative leverage point on something that, well, looks like a straightforward, possibly eligible for like 65% LTV. But Life Insurance Co. being the lender here kind of explains the leverage point, I think, in and of itself.
Yeah, I think if you ask the Life Co, they would say that was probably an aggressive deal on their end. They like to stay in that 50% like even range. 57 is probably pushing the boundaries for them at some level. But yeah, all in all, I think three good industrial stories. We love it when we have industrial transactions or industrial stories that we can share. We know it's a crowd favorite. And so today we tried to give you, three pretty reasonably priced, but good, solid industrial transactions across the U.S.
And let's close. We saw one lodging story in Washington, D.C.
So the one transaction we have here is in suburban Washington, D.C., with the hotel selling for $47 million. SAK Developers has paid $305,000 per room for the Hampton Inn and Suites National Harbor / Alexandria area hotel in the Washington, D.C. suburb of Oxon Hill, Maryland. The Ashburn, Virginia developer acquired the property from Blackstone Group's BRE Hotels and Resorts unit, which had purchased it in 2014 for $25.4 million. JLL's Hotel and Hospitality Group arranged the property's most recent sale.
Yeah, Blackstone, they still stack those wins on the scoreboard. I know there's been some challenges for some of their portfolio, but this is an example of something where they basically doubled their money up in 10 years. Not a bad trade for them. And it's interesting, Stephen, I know, we've released some of the taller stuff, and I think Haley's going to give a shout out to the webinar we have upcoming, but we've seen a retrenchment in some of the criticized office loans, especially in DC, third quarter to fourth quarter. And you may be starting to see some of those other transactions come back to life there too. So I don't remember seeing any like major headlines where the government's forcing people back in the office or anything in that market. But it does feel like through the data that there's maybe been a positive shift in DC relative to what we were thinking was going to take place, call it 6 or 9 months ago.
Yeah, I agree. It's too soon to say like if this is going to be some continuing momentum we'll see in that market, because I can tell you just from chatting with some folks over the last 2 weeks, there's definitely some bearish sentiment around, Washington, D.C. certainly didn't come up as one of the top picks to invest in. It was more in like we're kind of cautious or avoiding that market segment. So to see deals get done like this is definitely a positive to your point.
We were all very bearish on them, but given some of the most recent news, maybe it's kind of hit that trough you mentioned at the intro of the pod today.
So I'll turn to some programming notes. You mentioned this, Lonnie, but we do have an upcoming taller webinar on Tuesday, March 9th. And just as an aside, I think we all have slightly different accents, and taller is not a normal word. So I have enjoyed seeing our listeners write in asking for the taller data and spelling it in all different ways, because it is an acronym and it doesn't really sound normal. But just so everyone knows, that is our bank CRE loan data set. We pull in aggregate anonymized data from banks across the country, large and mid-sized banks, and we get a lot of insights from their delinquency stats, origination, and more. So if you're interested in getting a deep dive into the bank segment, send us an email to podcast@trepp.com. Stephen and some of our other experts, Sumit Grover, Emily Yu, and Eric will all be sharing their insights and some of the takeaways from our recent data there. So send us an email and we'll give you the link for that. And then on the topic of events, we mentioned this briefly last week, but I wanted to give another plug. So something that we do here at Trepp, and as you all know, because you're listening to something that we do right now, we do a lot of free educational content, whether that's webinars, podcasts, blogs, research. We're a data company. We have a lot of data and insights to share. So we try to do our best to get that out into the market in as many ways as we can. But something new that we want to bring to you all this year is an exclusive CRE event in person, where you'll have opportunities to network, join us for a happy hour. You'll get hors d'oeuvres and drinks and meet with others in the industry. And then you could join us for a half-day event where there will be panels and presentations and speakers from across the industry, and Stephen and Lonnie doing somewhat of a live podcast. So this is something that we require registration for, but we want to open it up to all of our podcast listeners. We have discount codes. If you reach out and you're a loyal listener, we'd love to have you there. So that is taking place in New York City, right in Rockefeller Center, on May 9th and 10th. And we'll have a lot of great people there, attendees, from all across the industry. So email us at podcast@trepp.com. We'll get you on that list and send you the code to sign up. But we're really looking forward to meeting some of you all in person and getting to know some of our listeners.
So Haley, you mentioned earlier that that we all have different accents, and so people sometimes type things funny. There's a word that Steven says that I laugh internally every time he says it. I say the word measure. Steven says the word measure.
Measure?
Wow, I never noticed that.
Yeah, so do you say measure or measure, Haley?
Measure.
Measure.
But I'm from Long Island, and growing up, everyone asked if I was British. So I don't really know what my accent is.
Well, I will say earlier when you were doing the shout out for our upcoming event, you said y'all. So I think the Texan and Steven and I
No,
rubbed off on you as
I don't
well.
say y'all. It must have been
It's
a
it's on the
combo of
tape.
two. I'll
It's on
listen
the
to
tape.
that.
It's on the tape.
And turning to shout outs, we had a lot of people this week request our taller data and want access to some of our webinars. So Robin F, Avi S, Chase K, Amna N, Dan M, Alex Z, Jonathan G, David L, Dan W, and Arthur F. And then a bunch of you guys had some comments for us. Andrew J said he loves the podcast and was interested in our daily email. John H found our latest podcast to be interesting and informative and wants to be on our list for future news and reports. So if you're not getting our email, send us an email and we'll make sure you're signed up. John B, our friend Dr. Debt Yield, who we coined last week, said it was great geeking out with you, Steven. So I think we're now doing a shout out for our shout out. But thanks, John, for all your continued engagement. And we hope we get to meet you at the conference in May. Jason W is a big fan of the podcast and was interested in our events coming up. And Aaron L and Mark E sent us some more color about an acquisition that we talked about a few weeks ago. So we'll dig into that in one of the next few episodes and share some of what they sent to us. Andrew L was interested in our Future CRE Leaders program. So if you didn't hear us plug that, if you're an aspiring commercial real estate professional and you're graduating this year, or if you know someone who is, reach out to us. We have a program that gets you recognized, put it on your LinkedIn, share it with new jobs, and it's really great recognition. Brandon W is a big fan of the podcast and was interested in our events. Ewan K listens to the show weekly and looks forward to every episode and told us to keep it up. And Clayton T was also interested in our Future Leaders program. So thank you to all of you guys for reaching out. We really appreciate it. And Lonnie, this one might be for you, but Dan M was a little offended. He said he saw you at that Dallas event last week, but he didn't get a shout out. But I told him it's probably just because you shouted out the people who emailed in, and that was all.
Yeah, what's funny is what Dan M doesn't know is that he got about 10 minutes of conversation between you and I, Haley, prior to the pod airing, because I told you that I ran into him. He was looking dapper. He made me remember the Texas Legend nickname. So Dan M, my bad. You're still my boy. All good. You getting the shout out, getting a little extra shout out today. No intentional omission of the Dan M shout out. In fact, it was really cool to see him in the Dallas area and be able to give him a firm handshake. And I hope that his business dinners that he was in town for were fruitful for him. I do have a couple of other shout outs this week too, Haley, so I'm going to go ahead and jump in there. So one of my friends and counselor of real estate contemporaries, Ruth Culp Haber, had a really nice write-up in the Real Deal magazine this week talking about her role in the office sublease market and how she's really carved out a nice niche for herself there and been considered the queen of the sublet at this point. So her and I are actually on the Counselor of Real Estate New York Conference Planning Committee together. And so it was really great to see her getting some flowers because I know she moves a lot of square footage and does a lot of deals in the New York market. So if you haven't checked that out, you should check it out. Really great write-up about her and kind of her career trajectory and where she started out and where she's at now. Really well done and a really great job by her of just, what do they say? If you can make it in New York real estate, you can make it anywhere. I think she's a testament to that. So a nice shout out there. And then Jackie S. from the Mortgage Bankers Association invited me to speak at the MBA's Impact seminar today. And it was a really great, well-attended event. got to see our friend Mike F. from MBA and a few others. And, it's really great to see the young people that are entering our commercial real estate profession. I know Stephen and I do a lot of these presentations. It's amazing how sharp these, up and comers are in terms of wanting to learn about CRE, their interest, their ability to leverage technology. It's a really great spot for our industry right now. So I had a great time there today. I really appreciate the opportunity to present, and I wanted to give Jackie a shout out.
And one more shout out and a closing note for us today. I have to give a shout out to our product director, Trisha, who called out that it is our 250th episode. So she said she was toying around in our product Trepp Siri and noticed the player that we have in there where you can listen right while you're working, said episode 249. And she said, Haley, what are you guys doing for episode 250? So she sent us over some interesting stats from the product and some other things that she thought would be fun for us to talk about.
So one of the exercises that Trisha had was that since this is our 250th episode, and her being a product manager, and a really great product manager, by the way, she had done some research in our tool and found that we have 6 properties in our Trepp CRE database that are actually 250 years old. So one of them is a Fannie Mae deal that just paid off on April 1st. And so what we were going to do, and I don't know, Haley, if this is, I assume we're okay to do this. Stephen and I weren't around 200 years ago, even though we're old compared to you. Kind of look at the market, a glimpse of the CRE universe 250 years ago. So if we had a drum roll, now would be the time to put it in there.
So funny enough, if we roll back the clock 250 years ago, there was still lots of political discord. And one of those examples is of colonists self-identifying as American. They came with the 1760s protests against the British Parliament. Ironically, Londoners had long been using the term as a derogatory name for colonists, much like Yankee Doodle would later be reused by colonists to mock those British citizens doing the insulting. So, there's still that same tit for tat going on today. Just granted it's domestically, but, good to know. Times have changed a lot, but some things remain the same.
Yeah, and I'll say there was no Trepp 250 years ago, unfortunately. So the market was way less informed than it is today. So luckily, 1979, Trepp was formed. In the 1990s, we started receiving the CMBS data, and we started bringing market transparency that was unheard of 250 years ago.
Good plug, Lonnie. Well, happy 250, guys. Every week that goes by, I can't believe we have another one. So thanks to everyone for listening and making this show worth it for us to do, because you keep on listening. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.